Shri Gurubhyo Namaha children. In our previous class, I was discussing with you the bills receivable turnover ratio. Today I'll be discussing with you bills payable turnover ratio. Okay. And what do you mean by bills payable turnover ratio? Or bills trade payable turnover ratio? So turnover ratio, it's a comparison of net credit purchase with your average trade payable. Right. Now, see here, the trade payable turnover ratio is a comparison of net credit purchase with the average trade payable during a accounting period. Now, it gives the velocity of payment of the accounting period of cash towards the trade payables. Now, it is calculated. So, we were discussing about the trade payable turnover ratio. It's a comparison of net credit purchase with the average trade payables during the accounting period. Now imagine you are running a trading firm where you buy and sell things from your wholesaler and then sell it to the customer. Or you are having a factory where you make spare parts or make a two-wheeler or a four-wheeler or brakes or whatever you're making. You might have purchased your raw material from your producer or from the place where you are getting it, or you're in the trading business and you will be buying things from your wholesaler. So you have to pay your creditors, right? So you'll be having some credit terms, maybe 15 days credit or 20 days credit, 1 month credit, 2 month credit. So you should calculate the speed in which you are paying the cash to your creditors, isn't it? For that only you calculate trade payable turnover ratio. So it gives the velocity of payment of cash towards the trade payables. So it is calculated as follows. So what is the formula? Net credit purchase. How do you calculate net credit purchase? So net credit purchase is nothing but total purchase minus your return, purchase return. Right? That is your net credit purchase divided by averages. Average, you know always how to calculate opening trade payables plus closing trade payables. It's not only bills payables, you have even creditors. So total creditors when your trade creditors, okay, so opening creditor plus your closing creditor divided by 2. So bills payable, so it is creditors plus bills payable. So your trade payable is trade creditors plus bills payable. So average trade payable is nothing but opening trade payable plus closing trade payables. So greater the trade payable turnover ratio, them fast. That means your sale is very quick. So what your business is doing very well. Okay. So greater the trade payable turnover ratio, better is the efficiency of the management in managing the trade payable, as it indicates the amount due to the suppliers are settled quicker. So if you're able to settle the suppliers quickly, definitely you'll be having a good reputation in the market. So people will be willing to do business with you. Okay, in case you want to buy raw material from A, B, C, D. A you have been buying. So sometimes you want to change to A will always give a good comment to B. B will give a good comment to C. So you will have a good reputation and goodwill in the market. That means you are having a good cash flow. So whatever product you are manufacturing, you are able to sell it. Okay. So your greater the trade payable turnover ratio, the efficiency is better is the efficiency of the management. Right. Now, credit period payment. So, credit payment period you can calculate either in months or in days. Okay. Now, how are you? What is the formula to calculate your credit payment period? So, it is the average time taken by the business for payment of accounts payable. So, lesser the credit payment period, greater is the efficiency of the management in managing account payable. It indicates a quicker settlement of trade payables. So if it is months, it is days. So number of days means 365 days. If it is years, divided by 12. So now here 365 days, it is 12 months because number of months in the year is 12. So credit payment period, if it is in days, it is 365 days. If it is in months, then it is 12 months. So number of days in a year, 365, divided by total payable turnover ratio. You will be calculating whatever ratio you are calculating. you divide it, you will be getting your credit payment period. Within how many months or how many days you're able to pay the credit. Whatever you have purchased from your suppliers, you'll have to pay them, isn't it? So how are you able to pay them? Right. Now let us go to illustration number 10. Let us solve the problem. Let us solve the problem, then it will be easy for you to understand. Now you're in illustration number 10. Right. Now, from the following figures obtained from Kalpana Limited, calculate trade payable turnover ratios and credit payment period in days. They want it in days. So they've given you some details. Credit purchase they've given you. They've given you trade creditors opening and closing balance. You have to find the average. They've given you payables, bills payable opening and closing balance. Now let us first of all write the formula. You're supposed to prepare your trade payable turnover ratio. So trade, trade payable turnover ratio. So what is the formula for that? Net credit purchase, net credit purchase divided by average receivable, average trade payable, not receivable, payable. Okay. So what is your net purchase here? 1 lakh. Okay, see your net credit purchase is 1 lakh divided by average trade payables. Now you have your opening and closing here, right? So you have to take an average. When they do opening and closing balance, you have to find the average. So 20,000 plus 10,000 divided by 2. Okay, now here plus 4,000 plus 6,000 divided by 2. So that is what you have your 20,000 plus 10,000, 30,000 divided by 2, that is 15,000. Fine. So for 4 plus 6, 10. 10 divided by 2, 5,000. So here you have 1 lakh. Okay, so that is 1 lakh divided by 20,000. Fine. So 4, it cancelled. So 2 will go here 5 times. So 5 times. This is your total payable turnover ratio. Fine. Now what is the second part? So your answer is 5 times. Fine. Now you are supposed to calculate your credit payment period. Credit payment period. Within how many days? Yes, they've asked you to calculate in days, right? So number of days in a year divided by, what did you find out just now? Trade payable turnover ratio. Fine. So that is what? 365 divided by 5. So 365 will go in 5 how many times? You have to divide and find out. Okay. So 5, let us divide 365 days divided by 5. So 7 5s are 35, 1 by 5. So that comes to 73 days. So we are able to make your payment in 73 days. Fine. So that is your illustration problem. Now shall we go to the exercise problem? Okay. I'll teach you how to do problem number 10. This is your exercise problem. From the following figures obtained from Arjun Limited, calculate trade payable turnover ratio and credit payment period in days. Now your credit purchase during 2018-19 is 9,50,000 and you have your total creditors, not your total creditors, your opening creditors and your closing creditors opening bills payable and your closing bills payable. So now that you are very much familiar with the formula, now let us calculate the not total, trade payable turnover ratio. Trade payable, trade payable turnover ratio. So how do you calculate it? Net credit, net credit purchase divided by average trade payable. Right. So what is your net purchase? Your net purchase, let us see from the problem. Net purchase is 9,50,000 rupees. 9,50,000. Fine. And then divided by, you have your creditor 60,000 plus your 50,000. So you have to find your average. They're giving you opening and closing, right? Then 45,000 divided by 2. So now you have here 1,10,000 divided by 2. So you have 55,000 plus you have 45, 50, 80,000 divided by 2. So that comes to 40,000. Right. 95,000, 9,50,000. Where you have 9,50,000. Fine. Now let us complete the problem. So you have here 9,50,000 divided by 95,000. So that is equal to 9 will go here once, 9 will go here, 95 go here once, 95 go here 10. So you have 10 times. Your trade payable turnover ratio is 10 times. Okay. So what is your debt payment period? Your debt payment period. Your debt payment period, they want in the problem, they want it in terms of days, right? So number of days in a month, number of days in a month or year, number of days in a year, divided by trade payable turnover ratio. Trade payable turnover ratio. Right. So that is how much? 365 divided by 10. So just a decimal point, isn't it? You get 0 cancel. So 336.5 days. So that is your debt payment period. I hope you understood, children. Thank you. See you in the next class with the next problem.